Today's show is purely about property as I chat with Dr. Andrew Wilson about what's ahead for our property markets for the spring season. But when we look back, clearly our property markets in Melbourne and Sydney bottomed out in the middle of the year because now it's not just auction clearance rates, it's not just asking prices, but the results are showing that property values are increasing as well. Consumer confidence is increasing, tax cuts have come in, interest rates have lowered, and that has created the naysayers, the doomsayers, to become boomsayers, because all of a sudden, some of those commentators who are telling us our property values are going to slump even further are suggesting that next year property values in Melbourne and Sydney could go up double-digit growth, and Brisbane property values, others are saying, will go up 20% in the next 3 years. So what's ahead? Today in this show, we're going to play you the audio of the regular weekly videos that I do with Dr. Andrew Wilson in our Property Insider series. But Andrew and I discuss the realistic outlook for our property markets. And by the way, it's really good. And at the end of the show, Andrew is going to go through state by state, explaining to you where he sees the best performing segments of each property market are going to be. So lots of information to help you become a more informed property investor. Welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Well, it's spring, traditionally a time when there are more home buyers and more sellers in the market. But what's going to happen to our property markets this year? A seller's going to return, a low interest rate's going to bring more buyers back into the market, a bank's going to become more friendly. If you're a homeowner or a property investor, you're probably also going to want to know what's going to be the value of your property as the year moves on. So to help you become a better informed homeowner or investor, let's hear the thoughts of Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au, and he's going to give us some of his thoughts about what's ahead. Welcome, Andrew.
Thank you, Michael. Yes, happy spring.
Well, yes, it is spring, and it's interesting looking what has happened this year. Like every year, there's been lots of news, some good, some bad. So let's look back a little bit and then we can move forward. Maybe we could start with the world economic environment, because Australia's economy and Australia's property markets don't work in isolation. It seems like things are a little bit more volatile than at the beginning of the year, Andrew. There's the China-US trade wars, US and Iran, the Fed's cutting interest rates. What's going on in the world and how's that going to affect us?
Well, as you said, Michael, there's a lot of issues percolating currently or have been percolating this year. Of course, they're headline grabbers. The China-US trade war really hasn't had a material effect on the global economy, except for sentiment, of course. We have the issues over Brexit, which is now reaching its climax, it would seem. So all those naysayers regarding the outcome of Brexit will either be proved right or as more likely wrong. And of course, we have the general, movement of the real sentiment in the economy, and that's monetary policy. And there's no doubt that it's shifted this year from predictions of perhaps a tightening of monetary policy continuing in the US and commencing in the Eurozone, but that's now reversed. And we now have an easing of monetary policy. US have cut rates, likely to cut again perhaps, and certainly some easing of conditions, monetary policy conditions in the Eurozone as well. Of course, we've cut rates twice and likely to follow on with one or two more perhaps. And New Zealand also cut its rates. So that's how the economy has swung in terms of real economics this year. And that has been a swing from a tightening of monetary policy, which is obviously a positive view on the growth of economies, to a easing of monetary policy, which obviously reflects some concern over growth going forward. But look, the big picture is in terms of the housing market that this doesn't make any difference. The real issue with our housing markets has been the restoration of confidence, which was always going to come, Michael. It was just a matter of time because it was a fear-driven market over the past 12 months up until June. And of course, those lower interest rates have done what they always do. They improve affordability, they increase confidence and get buyers and sellers back into the marketplace. And we have clearly seen that since the re-election of the Morrison government.
Well, Australia's economy and Australia's property markets have been so different. It was sort of two halves so far this year. There was what Scott Morrison called the miracle election. We've seen APRA loosening their grip. We've seen some tax cuts coming back, putting more money into people's pockets. As you said, 2 rate cuts, June and July. And the market's factoring in 2 more likely rate cuts. But we've had higher underemployment, Andrew. So there's been a rising participation rate, and that's been keeping wages growth low. And we know that wages growth is one of the very important factors in being able to drive property markets. I read recently, Andrew, that if you add together unemployment and underemployment, we've got 13.5% of Australians in that category. So there seems to be little wonder that we're going to have low wages growth moving ahead, Andrew.
Well, that's right, Michael. We've seen some signs that wages growth is starting to pick up from very low levels. Public service wages growth has been sustaining overall income increases in terms of wages over the last year, but we've seen the private sector starting to pick up. And as you mentioned, there are issues to do with a lack of competition in the labour market, which of course comes from either migration or higher participation rates that has kept wages growth reasonably subdued. But look, this is a factor right around the world. This is why interest rates are always going to fall. The about face by the Reserve Bank was eminently predictable. We've had low incomes growth for a couple of years now, and of course that has meant very low inflation. And now we're seeing rising unemployment. But the labour market outcome really is, again, a peripheral issue in terms of housing market energy. It doesn't really traditionally affect what happens in our housing markets movement in the labour market or the unemployment rate up and down, because they do reflect really at the end of the day where interest rates go. Typically lower unemployment leads to higher interest rates as the economy grows and inflation rises. And of course, higher unemployment typically reflects a need to stimulate the economy with lower rates. And of course, the rule book's been thrown out the window because those lower unemployment rates didn't lead to higher inflation or higher wages. And now we're moving into this period of still pretty good labour market activity, regardless of those issues about underemployment. But now we've got rates down, and they're still going down. And of course, that means we've got a real spring in the spring market.
Hey, a good alliteration there. And that seems to be coming from more confidence. There's more confidence, particularly in the buyer market. And we have at Metropole noticed a lot of investors coming back, people who've sat in the sidelines. Clearly, they're still having difficulty getting finance. Beginning investors are having an easier time than those that have got already a significant portfolio because the banks are looking at their serviceability criteria much more carefully.
That's right.
But what this has led to, Andrew, over the last few weekends is exceedingly high boom time auction clearance rates. Now, some of the things we've been looking at, some of the market indicators are lagging indicators, what's happened to prices before. I know you and I like looking at leading indicators, what's likely to change in the future. But auction clearance rates are real time, and clearly there are more buyers out there, there's better sentiment. And in the past, auction clearance rates in the high 70s would have led to, over the next 12 months or so, double-digit capital growth because the supply and demand. What do you think's ahead this year, though?
There's no doubt that we've had a building market over winter, Michael. The winter market ended with clearance rates almost extraordinarily over 80% in Melbourne and Sydney, but also the smaller markets record very strong results, relative sense as well. Adelaide, Canberra and Brisbane also recorded strong auction market activity. And of course, as we know, history tells us and logic tells us that strong competition for property, which those high clearance rates reflect, always leads to higher house prices. And I would expect to start to see a building of house price growth over spring, but not at those levels that we've seen previously 3 or 4 years ago, where we did have those 80% clearance rates consistently, and we did see double figure growth. Most markets will work around about 3 to 5% next year. Perhaps the risk is on the upside, depending how many rate cuts we do get. I hope we only get 1, maybe 2 more. We need to keep something in reserve in case we get a real economic shock rather than this sentiment shock that we have at the moment. But I still think that around 3 to 5% in most markets is a conservative and a realistic outcome, but it's certainly a lot different to the predictions that were made by those that are now swinging across to the bull side of the argument that were made earlier in the year where it was 10% down. We can be certainly confident that the markets are now consolidating, that we will see more sellers into the market. Early signs, Michael, that we are now starting to see sellers come back. Shouldn't be surprised at that because obviously high clearance rates and a sense that prices are starting to rise will bring those sellers back into the market. And of course, most sellers are buyers and buyers are sellers. And we will see a traditional spring market where volumes do rise over the spring period. And that typically means lower clearance rates as we get to the end of the year. As you suggested quite clearly, Michael, the missing link are investors. They're still a little bruised and battered over the questionable APRA policies that really cracked the market through 2015 up until this year. Now they're sitting on the sidelines, again, predictably, given, I guess, the stress that caused the marketplace. But also banks are a little bruised and battered in terms of feeling they still have to be prudent in their lending, particularly to investors. So it'll be still a little tougher to get loans for investors who will be feeling a bit more positive about the market. And they'll certainly, once those price growth outcomes consolidate, they'll still be looking quite interestingly in getting back into the marketplace. But you really would need those levels of investor activity that we had when we did have previously those 80% clearance rates to get those sort of double figure prices growth that we had in 2015 and 16 and 17 in Melbourne and Sydney.
It's great news, Andrew, at a time when inflation is low, when interest rates are low, when the cost of money is low.
Yes.
So therefore, you don't need double-digit growth when it costs you 3.5% to borrow money and to leverage. Yes. And if we do move to the next stage and have boom conditions, the Reserve Bank is going to be finding itself in an interesting and an awkward position. It's painted itself in the corner. Yeah. And booms lead to bust. I'd much rather have an orderly rise in property values. Single-digit capital growth next year sounds very good to me. Clearly, there's more confidence in the market, but as you say, banks are tougher in their lending practices. There's also segments of the market that are not going to perform well. There's still the new apartment stock. There's a lot of it coming onto the market at a time when consumer confidence has disappeared from that. They're wondering, is the building going to crack? Is it going to value up to what I paid for it? So there's some segments that are still going to have some problems, Andrew.
Well, that's right, Michael. And we are at peak supply now in terms of apartment markets in Sydney and Melbourne. Sydney's probably got the better prospects, and Brisbane, of absorbing that excess stock at the moment. We're seeing signs of that. Brisbane also is actually coming quite sharply back into a balanced position. There's going to be very few new properties, particularly apartments, coming into the marketplace next year in Brisbane. And of course, with migration still ticking over, particularly strong net migration into southeast Queensland, people will be looking for somewhere to live, and that, whether it's to rent or buy, will continue to push rising demand in a market where there's falling supply. Similarly, in Melbourne and Sydney, I think Melbourne's issue is a little bit around not so much the net supply demand ratio, but it's also about where a lot of those apartments have been built. And I think that that's part of the issue that the Melbourne market's had in clearing its apartment stock, has been the type of product and the location of the product that developers were keen or did develop through that very strong period a couple of years ago. And of course, really the end of the Chinese interest in the investor type apartment market in Melbourne has been a severe blow to absorbing a lot of that supply. And that means the Melbourne apartment market journey will be a little longer than Sydney and Brisbane. The Sydney market particularly is exacerbated by concerns over structural integrity. That certainly makes a buyer of a new apartment now particularly wary, and it's for developers, it's the last thing they need. It's quite concerning that these issues should be, I think everybody takes it for granted that regulations are strong enough to ensure that buildings are built as they should be built. Look, it's a very good environment moving forward now. Perhaps it's a normalisation of the market now, Michael. And I think the real positive is the uncertainty's gone now. I think everybody's pretty clear that the markets are in an upswing environment. Doomsayers are now swinging to boomsayers. I guess we just sort of Google those boom-saying comments and look at the same names saying the complete opposite 6 months ago. And as I said, early signs are now starting to consolidate, that listings are now coming back into the market. Interestingly, over winter, Michael, there wasn't, over August, the last month of winter, actual turnover of sales wasn't that far below. It was higher in Sydney and not that far below what it was last August. So the actual turnover of property, although low compared to the boom time years, is starting to normalise as well. And look, it's a journey, and we've been battered and bruised through an unprecedented fear campaign, through a credit squeeze, which really should never have happened. And now we're starting to see the clouds clear, blue sky, and it'll be a very positive environment, I believe, for both buyers and sellers through spring market. And I think in just about all capital city markets as well, they can look forward to some confidence and pushing aside let's hope they push aside the boom side, the boom time narratives, just as they should have pushed aside the doom side narratives 6 months ago. But human nature, who can say?
So I see two tiers of apartments coming forward. There's still concern about those new apartments for a while until all the regulation works its way through. And I can see that as the next cycle of new construction comes on, Andrew, developers are going to have to be more careful, builders are going to have to be more prudent, regulators are going to have to be more vigilant, and that's going to mean the cost of the next round of apartments, the construction cost is going to be higher. And so that's, again, going to just be one of the many factors, all the bits in the jigsaw, keep property values increasing in Australia. And it's also going to increase the value of when you and I grew up, what we used to call flats, those 2 and 3 story walk-up buildings that are built solidly with a high land to asset ratio, not built out of paper mache. People are trading backyards for balconies and for courtyards. So I see flats becoming a safer alternative for many investors and home buyers. And the price of those older established ones will get pulled up by increase in price of the new ones. So moving forward, where do you see the strength happening? What are the likely best performers in our spring market?
Well, interestingly, Michael, we saw a couple of hotspots develop, if I can use that term, which I don't like using. The auction clearance rates were telling us that. We look to Melbourne to start with. The eastern suburbs did quite well. Now, the inner eastern suburbs, which of course are traditionally Melbourne's prestige areas, they start to pick up after having quite a subdued period for the past year. But the real mover in the Melbourne market has been the outer eastern suburbs, which is really those broad areas, suburban areas to the east of Warrigal Road, if I could use that as a benchmark. A lot of those suburbs, those middle ring type suburbs, really buyers are very keen on securing them. I guess they're mid-price range areas, Michael. Aspirational for that middle price range buyers, certainly back in town in those areas, all the way out to the Dandenongs. And I think they'll be very good performers. Last year it was the northern suburbs and the northeastern suburbs. This year it looks like being certainly the jungle drums are beating strongly for the eastern suburbs. The auction markets in Sydney are always quite robust in the inner suburban areas such as the city and eastern suburbs, the lower North Shore, the northern beaches and the inner west. Now they've actually been, not surprisingly, quite strong during the winter period, but we've seen some breakout suburban action, particularly from the northwestern suburbs, Michael. Now, the Hills District has been an underperformer after being very strong about 4 or 5 years ago, perhaps too strong, but there was a lot of development in the Hills, particularly apartments in that northwestern area of Sydney. But that's now started to pick up and really had quite a strong winter period, the Hills area, and also the southern Shire area of Sydney as well. Also had some strong results. And if we look at Brisbane's been steady-ish. It, of course, suffered, as most markets did last year, from the credit squeeze. Tap was turned off for investors, which was quite bewildering given that investor activity was certainly quite normal. So why Brisbane investors had to pay the price that Sydney and Melbourne did for their strong activity is beyond me. But anyway, there's certainly strong demand for inner city, larger sized apartments in Brisbane, areas adjacent to the CBD area, that Tenerife, Hamilton, perhaps a little further out, but New Farm. These types of areas are certainly got a lot of demand for 2-bedroom, particularly apartments, larger apartments there. I think that's a sign of the changing buyer demographic in those inner suburban areas in Brisbane. A lot of professionals are now looking for that higher density lifestyle, but a quality higher density lifestyle. It really is a whole new world for Brisbane. That quality inner city apartment market is certainly burgeoning, and lifestyle connections to that are also developing in terms of infrastructure and amenity. I think in Adelaide, again, the strong areas, and Adelaide's always got that great affordability in the mid to higher price ranges to the east of the city particularly. I think they've continued to do reasonably well. But Adelaide's economy is picking up, migration's picking up, net migration in Adelaide, and I think that'll be a steady performer. And look, to some degree, we're still waiting for the Perth market to find its bottom. It still has issues to do with excess stock in the rental market, but that's coming back to a more normalised. Always going to be a long journey for the Perth market to get back to finding its bottom, given how strong that economy and the fly-in, fly-out energy was 4 or 5 years ago. So, but I think that's certainly on the eastern seaboard and Adelaide, we're looking for a positive spring. As I said, I think we'll see prices growth around about 3 to 5%. I think won't be a lot of difference between the markets, and it's certainly refreshing, I guess, in a sense, to be talking not just about positives, but to be able to rationalise those positives with results rather than just be talking about fear and doom. And I think what we'll see is, given your comments regarding the Reserve Bank being caught between a rock and a hard place, if we do see strong prices growth, given that they've announced clearly that they are prepared to cut rates until they get a 4.5% unemployment rate, well, good luck with that. But if we had that failing to occur, that is higher unemployment, which I believe we will see unemployment ticking up. If we do get that and strong prices growth, where does that leave the Reserve Bank? I guess they pay the price for the sins of previous positions on the housing market that didn't reflect fundamentals. But it's certainly going to be an interesting spring, positive spring. And here we go again with all the positive talk in the media. So we're off and running, but it's all about property, somewhere to live in and somewhere to put your savings in and to make a decent return. And that's back to normal.
So spring has sprung and the green shoots are out, and they're going to be bringing us lots of news every week. So I look forward to having a chat with you each week in these Property Insider segments, Andrew. Thank you.
Good on you, Michael. Thank you.
So there you have it, another great chat with Dr. Andrew Wilson. In between the regular Michael Yardney podcasts, once a week I have a video session with him that we call the Property Insiders that you can subscribe to at propertyupdate.com.au. If you subscribe to my daily newsletter, you'll get information about it, and on the Michael Yardney or Property Update YouTube channel. But Andrew brings a lot of depth, and both of us have got long memories and we remember what's happened in previous cycles. I think that perspective is something that's missing with some of the other younger commentators. Having said that, if you're interested in growing your property portfolio, if you're interested in more success in life, stick with us. Twice a week I'm going to keep bringing information on the Michael Yardney podcast. And if you want to take your investment up to the next level, you've probably heard me say it a few times now, in October, not that far away, there's going to be my annual Property Renovations and Development Workshop. Go to realestateworkshop.com.au. There'll be a link in the show notes, realestateworkshop.com.au, because if you want to take advantage of the new stage of this property cycle where the markets are picking up, as you've already heard, but you want to manufacture some capital growth, if you wanted to get extra cash flow, build depreciation allowances, buy your next properties wholesale, take advantage of the proven strategies of renovations and development. My team has been involved in over 700 medium density developments, and we're currently involved in just under 50 of those at the moment. So you learn from people who are doing it, actual real world advice, what's relevant now. And we did 70 renovations last year, realestateworkshop.com.au. And what I'd like to remind you is that I'm hoping to help you become a better property investor, more successful in your life by giving you this information. So I'd like you to pass it on. Please help others grow their wealth through the information on the Michael Yardney podcast. There's a share button at the bottom of every podcast app, or just tell somebody about it through Twitter or Facebook, whichever way you like. And I really, really appreciate it when you leave me a review. It doesn't just make me feel good, but it does. It also tells other people, hey, this is a good show. And I recently got a review from Medhat Fathi, and that was an Apple podcast where she left a 5-star review saying, it's difficult to get unbiased opinion and advice these days. Michael is biased, okay, but because he loves properties and financial freedom, and who can blame him? Aren't we all biased in this way? But he won't sell you a lemon and tell you it's the best move. Definitely heaps of knowledge and experience that every investor needs to know, and amazing mindset moments. Well, thank you so much, Medhat Fathi, for your review on Apple Podcasts, and you, like everyone else who leaves a review, is going to get, if I read it out, is going to get a gift of one of my books. So as a way of saying thank you, if you email me, michael@metropole.com.au, I'd love to gift you one of my books. Between these podcasts, you can catch up with my thoughts and those of Australia's leading property experts, tax experts, finance, strategy at propertyupdate.com.au. And I look forward to catching up with you again real soon. In the meantime, spend your time wisely.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?